Silver didn't just move, it snapped. $64 an ounce in January 2026, and then, almost immediately, suffered a one-day collapse of roughly 27%. And the strangest part is what didn't happen. No major mine shutdown, no sudden invention that erased industrial demand overnight, no single headline that could honestly justify a move of that magnitude. They said moves like that could never happen in a modern, electronically cleared market. They said the plumbing was stronger now. They said deep liquidity, tighter risk controls, and professional market makers would soften every edge. Yet the tape showed something else entirely. A vertical climb, a violent air pocket, and then a rebound that left both optimists and skeptics staring at the same question. If silver can behave like that at triple-digit prices, what does cheap even mean anymore? Here's where it gets interesting. When a market goes nonlinear, most people look for a villain or a miracle. They look for a single cause because a single cause feels controllable. But the data shows patterns, and patterns have repeatable mechanics. In this case, the core driver wasn't a rumor. It was the cost of carrying a position. It was margin. It was leverage being repriced in real time. There's also an information gap baked into that process. Institutions track positioning, collateral stress, delivery tightness, warehouse movements, and the knock-on effects of index rebalancing. Most people see a chart and assume the chart is the whole story. What I'm about to lay out changes how the silver market should be understood, because it explains why the cheap silver era is over and why it doesn't simply come back after a pullback. The price can fall. The regime does not automatically reset. Welcome to Vault Signal, where we decode the mechanics that move markets before those mechanics become headlines. If you like analysis that stays calm, follows the numbers, and connects the dots between futures, physical inventory, and institutional flows, you're in the right place. Consider subscribing the way you'd keep listening to that wise elder who never yells but always seems to know what matters. And as you listen, drop a comment with where you're watching from, because this story is global, and the flows that move silver don't respect borders. Now let's reconstruct what happened, step by step, like a forensic report. Silver had been climbing with momentum that felt unstoppable. The daily candles didn't look like normal commodity trade. They looked like a market discovering a new reference point. Headlines leaned on familiar narratives: inflation hedges, industrial demand, monetary uncertainty, central bank credibility. Those narratives weren't irrelevant, but they weren't sufficient. The more powerful engine was positioning, because futures offer leverage and leverage can dominate. Price behavior when a crowd is leaning the same way. Leverage works like a megaphone. A small move becomes a big profit until the same megaphone amplifies losses. When prices rise quickly, traders pile into futures because futures let them control a large notional amount with a smaller cash commitment. The system relies on margin to make that safe. Margin is not the full value of the contract. It's a good faith deposit designed to cover expected losses in a volatile period. If volatility rises, expected losses rise, and so does margin. As the market surged into that January record region, there were structural flows running underneath the excitement. One of the most overlooked is index rebalancing. Commodity indices don't care about stories. They care about weights. When one component outperforms, the index is forced to sell some of it to maintain target allocations. That selling can occur over a defined window, and it can be large enough to matter. In early January 2026, analysts highlighted that the Bloomberg Commodity Index rebalancing could imply selling on the order of about 13,000 silver futures lots, roughly 9% of open interest. That is not a casual amount. That is a footprint big enough to shape price even if no one changes their long-term view. Put that kind of mechanical selling into a leveraged market and you create fragility, then layer in exchange risk controls. Clearinghouses are not there to make traders comfortable. They are there to ensure the system survives. When volatility spikes, the clearinghouse increases margin requirements. That's not a punishment, it's a safety mechanism. But it acts like a shock to anyone who is running tight funding. After the plunge, COMEX silver margins were raised for many participants to about 15% from roughly 11%, with higher requirements for accounts deemed riskier. That sounds technical, but translate it into human terms. If you were holding a leveraged position sized for an 11% collateral requirement, a jump to 15% is a sudden demand for more cash. If you have cash, you post it. If you don't, you reduce your position. If thousands of traders reduce at the same time, selling pressure becomes self-reinforcing, and price can fall far faster than any fundamental change would suggest. This is the central mystery that confused so many people watching from the outside. How could a market rebound after being crushed by forced selling? Because the selling wasn't primarily a change in belief about what silver is worth. It was a change in the cost of holding silver exposure through futures. Once the forced sellers were cleared out and the marginal leveraged buyer was removed, the market could stabilize. But that stabilization happened in a new psychological and structural context. A market that has proven it can trade like that is not the same market it was before, even if the price looks similar on a chart later. To understand why, you have to zoom out and look at the hidden pattern. Silver has a long memory, not because it's sentimental, but because the structure of its market invites the same cycle. When silver is considered boring, leverage builds quietly because the perceived risk is low and carrying costs feel manageable. When it becomes exciting, leverage builds loudly, often on momentum. In 1979 and 1980, silver's story was shaped by inflation fears and concentrated positioning. The result was a blow-off top followed by a collapse that changed participation for a generation. The lesson was that silver's upside phases attract leverage faster than the market's infrastructure can comfortably absorb, and when the infrastructure responds, the response is abrupt. In 2011, silver ran hard again, driven by post-crisis monetary anxiety and heavy speculative demand. Then, the same playbook appeared. Margin increases, rapid liquidation, and a sudden re-rating of what safe leverage looked like. Prices didn't drift lower. They dropped in a way that taught participants to respect the exchange's power to change the cost of staying in the game. Now in 2026, the pattern is repeating with modern complexity. The price moved into territory that would have sounded absurd not long ago. Then volatility triggered the protective response of the marketplace itself. And that's the point. Silver isn't like that. Its market is a layered system of paper claims, physical inventory, industrial necessity, and financial leverage, all interacting with rules that can change overnight. So who was positioned, and how do we know? One of the most revealing episodes was the role of a Chinese futures firm, Zhongtai Futures, in Shanghai's silver market. Reports indicated it built a substantial short position on the Shanghai Futures Exchange, equivalent to roughly 484 tons of silver, around $1.5 billion in notional value near the peak. During the rout, that position was reported to have generated profits around $519 million within days. That's not a small trade. That's a statement about timing, capacity, and the willingness to be early when everyone else feels late. That doesn't automatically mean a conspiracy. It means preparation and risk tolerance. A short that large is either reckless or strategic. In a leveraged market, strategic positioning often looks reckless until the move happens, and timing matters. While many participants were celebrating the record print, someone else had enough conviction to be heavily positioned for reversal and enough operational capacity to maintain that exposure through turbulence. Now bring in the Western market's set of players. Exchanges and clearinghouses, yes, but also clearing brokers, large commodity trading advisors, bank desks, and funds that must obey risk limits. When a market experiences a rapid run-up, risk models begin to flag higher value at risk. Funds that use volatility targeting start trimming. Brokers raise internal house margins before the exchange even announces its official change. Some desks reduce exposure because their mandate requires them to, not because they changed their mind about silver's long-term role. Then you have the regulators and reporting systems that shape how participants behave. Position limits, reporting thresholds, and delivery rules all matter more when a market heats up. The more attention a commodity gets, the more sensitive institutions become to reputational and compliance risk. That can reduce liquidity right when it's needed most. Liquidity is not a constant, it's a function of comfort. When the rules tighten and volatility spikes, comfort vanishes. This is where the dislocation becomes visible, because you start seeing two markets tell opposite stories. One is the paper market, which is dominated by futures and derivatives. The other is the physical market, which is dominated by inventory, fabrication demand, and logistical constraints. Paper can expand and contract quickly because it's mostly claims and hedges. Physical moves slower because it requires metal, transport, refining, and allocation. In London, Vault data showed silver holdings around 27,818 tons at the end of December 2025, up modestly from the prior month. On the surface, that sounds like a comfortable cushion, but inventory is not a simple pile of available bars. Some is allocated to owners who won't sell at the posted price. Some is tied up in leasing arrangements. Some is held for industrial clients that cannot substitute easily. Some is in forms or locations that are not immediately deliverable into the exact channel the futures market references. The number looks stable, but the usability of that metal can change dramatically depending on who owns it and what they need it for. Meanwhile, the futures price was reflecting the stress of collateral, not the calm of inventory. That's a dislocation. The paper market was being forced to de-risk because margin requirements and mechanical selling created a liquidity event, while the physical backdrop did not show an immediate collapse in availability. Price was screaming scarcity and then screaming liquidation. Inventory was whispering stability. Two narratives, two speeds. And there's another layer to the dislocation that makes this era different. Geography. East versus West is not just a catchy phrase. It's about where marginal demand and marginal hedging are coming from, and how different venues transmit stress. When Shanghai positioning becomes aggressive at the same time Western indices are forced sellers, you get a tug of war that looks chaotic on a chart. Yet the chaos has structure. One side is trading calendar mechanics and institutional risk controls. The other side is trading strategic exposure and regional demand dynamics. This is the part most people miss. A dislocation cannot persist forever, because either price converges toward the physical reality or physical flows adjust to the paper signal. If paper prices crash far below what physical holders consider acceptable, physical supply can withdraw, tightening availability and pushing price back up. If paper prices surge far above what end users can tolerate, substitution and demand destruction can slow the flow, easing pressure. But when both are constrained by short-term mechanics, the market doesn't glide into balance, it snaps into it. So let's lay out the evidence with numbers, because this isn't opinion. 64, followed by a collapse around 27% in a single day, and then a rebound. That alone tells you the market moved beyond normal volatility. Second, policy response, a margin increase to about 15% from roughly 11% for many accounts, with higher requirements for higher risk profiles. That is an exchange saying the probability distribution has fattened, and the system needs more collateral to survive it. Third, mechanical flow, an estimated selling requirement of about 13,000 futures lots tied to index rebalancing, around 9% of open interest. That is forced selling large enough to bend the market even if no one changes their mind. Fourth, concentrated positioning, a short position equivalent to roughly 484 tons and reported profits around $519 million. Whether every digit is exact to the last dollar is less important than the scale and the message. Large players can exploit structural stress, and they do it by understanding the mechanism, not by guessing headlines. Now, what does this mean for the idea of cheap silver? It means cheap silver ends, not because prices can't dip, but because the market's infrastructure has adjusted to a higher stress level. Once margins rise and volatility becomes accepted, the cost of leverage rises. Higher carrying costs reduce the pool of participants who can buy big dips with borrowed money. That changes the character of corrections. Dips become sharper, and recoveries become more dependent on real capital rather than fragile leverage. This is the part no one discusses enough. When a market proves it can move like that, it attracts a different kind of institutional attention. Risk desks start modeling it differently. Treasurers demand more collateral. Clearing brokers get stricter. Fund managers face questions from boards and investors about exposure. The result is a new baseline of caution. Even if the nominal price comes down, the rules and behaviors do not fully reset to the old easy conditions. That's why cheap often doesn't return in the way people expect, even after the excitement fades from the headlines. To make the mechanism simple without dumbing it down, imagine a crowded theater where everyone is holding a chair rented on credit. As long as the music is calm, the crowd feels safe and the manager is relaxed. But if the music suddenly spikes and the floor shakes, the manager demands that everyone prove they can pay for the chairs immediately. Some can, some can't. Those who can't are forced to return chairs, which creates a rush, which shakes the floor more, which makes the manager even stricter. The chairs didn't change. The policy did. That's margin. In silver, the chairs are futures contracts. The manager is the exchange and clearinghouse. The floor shaking is volatility. When the manager demands more collateral, traders who are comfortable at the old requirement become vulnerable. They sell, not because they hate silver, but because they need cash. And when enough accounts sell at once, price gaps lower, volatility rises, and margin pressures intensify. It becomes a feedback loop that can turn a normal pullback into a cascade. That feedback loop is how violent sell-offs happen without a fundamental trigger. It's also how markets cleanse leverage. After the cleansing, the remaining participants are better capitalized. That can support a rebound. But the rebound doesn't resurrect the old world where silver could be treated as a sleepy, underpriced metal. The memory of the event changes behavior. It changes how much leverage is considered acceptable. It changes how quickly brokers act. It changes how exchanges calibrate risk. And it changes how institutions talk about silver internally. Because once a market has proven it can do something, risk managers assume it can do it again. There is also a quieter mechanism that accelerates these episodes, hedging pressure from producers and fabricators. When price rises fast, miners and recyclers often lock in future revenue by selling forward, while industrial users may hedge input costs by buying. Those hedges interact through the futures curve. If the curve shifts rapidly, hedges can become self-reinforcing. A miner that sold at lower levels may face margin calls as price rises, forcing it to post collateral or reduce hedges. An industrial buyer that hedged late may be sitting on gains, but still needs to maintain collateral. These cross currents are why silver can feel like it has two personalities at once, a financial asset on the screen and an industrial commodity in the warehouse. Then there's the options layer, When a market runs toward a popular strike, dealers who sold options often have to hedge dynamically, buying as price rises and selling as price falls. That hedging can add fuel to rallies and speed to crashes. It's not malicious, it's mechanical. But mechanical flows don't care about narrative, and they don't stop to be polite. When a price spike pushes implied volatility higher, option margins can rise too, creating another corridor of forced behavior. This is why the phrase cheap silver is deceptive. Cheap suggests stable, sleepy, and easy to finance. But a market that forces these kinds of hedging cascades is not cheap in the only way that matters to institutions. It is not cheap to carry. One more piece completes the picture: bullion bank balance sheets and the short-term funding market. Large banks and dealers intermediate between investors, refiners, and exchanges. They warehouse risk and finance inventory, often through short-dated borrowing. When volatility spikes, internal risk committees can reduce credit lines, widen haircuts, and demand more collateral. That can tighten the availability of metal for lending and can change lease dynamics. Even if headline inventories look steady, the functional liquidity of those inventories can shrink when financing terms tighten. That's a structural reason volatility can persist beyond the initial shock. And that's why cheap becomes a misleading word. Cheap is not only price, cheap is ease of leverage, ease of delivery, and ease of financing. Once the system has shown stress, every participant prices in that memory. The metal can trade lower tomorrow, but the market will not forget what it did in 48 hours. In this regime, the floor is psychological as much as financial, and both floors tend to rise over. So what are the forward scenarios based on history? Not guarantees, not predictions, but conditional paths. If volatility remains elevated and exchanges keep margins higher, historically the market tends to trade in wider ranges with sharp resets. That's the conservative scenario, a choppy, higher-priced regime where rallies and sell-offs are both amplified, and the market spends time building a new equilibrium. If physical demand tightens while paper leverage remains constrained, historically the market can experience a grind upward punctuated by sudden squeezes. The moderate scenario is a staircase, not a straight line, where each step is tested by liquidity events, and the floor tends to rise over time as financing conditions keep speculative froth in check while real demand slowly asserts itself. And if institutional positioning in the East continues to clash with Western mechanical flows and risk tightening, the aggressive scenario is more frequent dislocations, larger price differences across venues, stress during delivery periods, and a market that periodically snaps to force convergence. In that world, the headline price becomes less meaningful than the signals underneath it because the market is repeatedly negotiating between paper claims and physical constraints. So, what should be watched? Indicators, not emotions. Watch margin changes and clearinghouse notices, because those are early warnings of stress. Watch open interest relative to price, because rising open interest into a rally often suggests leverage building. Watch inventory trends in major vault systems, because sustained draws matter more than noisy daily price action. Watch regional premiums and delivery spreads, because those reveal where metal is tight and where it is loose. And watch the calendar for index rebalancing windows and large option expiries, because mechanical flows are the modern version of predictable pressure points. Finally, there's a choice ahead, and it has nothing to do with being a bull or a bear. The divide is between those who understand the market as a mechanism and those who treat it as a mood. When the mechanism tightens, retail tends to react last. Institutions move first because they monitor collateral, flows, and rules. By the time the story becomes everyone's talking point, the repositioning has already happened. The wealth gap is often an information gap, not secret knowledge, just the discipline to watch the unglamorous data and to respect how quickly rules can change. The market does not reward the loudest voice. It rewards the best prepared balance sheet and the clearest understanding of how forced behavior appears. This is Vault Signal, where we decode what matters before its headlines. If this connected dots you hadn't lined up before, you know what to do. The question isn't whether the silver market will keep changing. The question is whether the next regime shift catches you watching the price or watching the system that sets the price.